Welcome back. One very interesting data set that we discuss when we're looking at the housing market is the median days on market. And very simply, what this shows us is the median number of days that the average property, a home for example, where it's listing will spend time on the market once it's listed in any given geography before that property is actually sold. Now, we can see here at the top there's a 48% positive correlation between the median days on market and the XHB. XHB is the S&P 500 index, which represents the home builder stocks, those companies that are engaged in the construction of single-family homes and even entire housing developments. Now, a 48% correlation is a very strong or a pretty strong correlation, I would say. A 100% correlation occurs when one stock goes up by 1 point, the other stock up also goes up by exactly 1 point. 48% is pretty strong. However, we're going to see in a moment, this data I think is a little deceiving. The red line represents XHB, the home builder index. The black line represents median days on the market. And what I believe what's happening is that the home builder stocks, the red line, are acting as a forward-looking mechanism. Stocks by nature are a forward-looking mechanism. We're all buying and selling stocks in anticipation of future earnings, the future performance of that company. So I believe what's happened is that traders, investors have sold the home builder stocks in anticipation of this black line actually going up. See, this red line started to decline after hitting a high in January and hit a low in April. However, this black line really didn't start to move up until about May or June, and that's in reflection to the longer amount of days that the average property sits on the market. So I think that traders sold the stocks over here in anticipation that the median days on market would then go up a few months later. Now, the black line shows us the median days on the market, and the orange histogram bars show us the federal funds upper brackets. And we can see that both indications hit lows around May of this year. Federal funds rate hit its very, very historic low, and at the same time, the median days on the market hit a low level of 31. 31 days the average property would sit on the market before being sold. Well, as we can see, the federal funds rate has a very significant impact to the number of days that the average property will sit on the market. Logically so. The higher the interest rates are, the more expensive it is to buy a home, especially if we're taking into consideration a mortgage. So we can expect if interest rates will continue to rise, if no other factors change, I would expect this number to, travel higher or at least remain near these levels. If we start to see reason for the Federal Reserve to reduce interest rates, well, we may see the median days on the market turn lower. However, what we saw from the previous chart, if we expect that the median days on market will turn back to the downside, I would expect that the home builder stocks would actually move ahead of that. We hope this has been helpful. We look forward to seeing you back soon.